Afternoon traders, this is Christian Farmer, Target Trade Group, and this is your end of day market recap for Friday the 13th. Happy Friday the 13th. Hopefully that's going well for you, and hope you also have a great Valentine's Day ahead for the long weekend. Let's get into the end of week wrap up. I will go over just kind of where we are at this point because we're officially now through a month and a half of 2026. Right, we're crossing the halfway point because we won't be back until Tuesday. And a reminder: make sure that you subscribe to my YouTube page. I will be interviewing Helene Meisler on Tuesday at 12 o'clock. We'll broadcast that on YouTube. We'll also save the recording if in case you can't make it. But we'll probably talk for about a half hour or so. I think it's a great place to kind of review, talk about what's going on. She does an exceptional. She calls it a chart fest every Saturday, which I think is great because one of the things that I really like about Helene is that she's extremely objective in what she does. She's not perma. It doesn't seem like she's perma anything. So she's a great follow. So anyway, that will be on Tuesday, and but overall, it's a great place to kind of just look at where we are at this point in the market. Some definite changes going on, I think, in the market, and I think there's some contributing factors to that, and I'll talk about that. I'll try to talk fast so that this video won't be too long. But here's basically where we are, and I'm just going to turn the camera off so that you can see more of the spreadsheet here. But I like to review at this point just where we are year to date because SPY is essentially flat for the year, which is kind of crazy to me because a lot of people are. I see a lot of different posts floating around about how many stocks have had big drawdowns or have really fallen quickly. um yeah, I mean, there's a combination of things that are going on, I think, in this market, one of which is that there's been poor liquidity for a while. Like, you could see that. There was this story yesterday, for example, about there was some previous karaoke company that came out and said something about AI and transportation companies, logistic companies, and stocks. Four or five of these transport stocks fell 10 to 15%, no problem. And to me, it just shows like that's, number one, that's not normal. Number two, it just shows that there's nobody's taking the other side of that. And it's happened to me a couple times. I got caught in a couple trades at the end of January where I was in names and I was like, I don't even see what's going on in these names, and they're just falling with no problem, 5, 6, 7, 8%. And if you're not quick with some of these names, anyway, it can really kind of put a dent in your P&L. But you think sometimes, wow, this shouldn't be happening. I don't even see any news on this stock, but it's just a situation of liquidity. And I think that has to do a lot with positioning and where we are at this time. I've been saying for a while now that it's one of the things that I'm really concerned about with the market is that there's just no cash on the sidelines in terms of and I have to be careful the way I say this because somebody will get mad at me, but cash on the sidelines meaning like for if a fund is managing $100 million, right? We've heard from surveys that the Bank of America Fund Manager Survey saying that the cash in these funds are at an all-time low. So institutions are full boat, and we know that retail investors are full boat with margin, which is from the last margin report that we got at the end of November, seeing record balances in what retail has in margin. One other thing before I kind of jump into the numbers is that we heard about this coming into this weekend that there was going to be the program selling of CTAs would be unwinding some of their max long position. And I think that's why we kind of saw markets do what they did this week, where kind of a little bit of everything sold on a couple days, specifically Wednesday and mainly Thursday. But things bounced back a little bit, some of the oversold areas. So I'll go through some of those charts. But yes, what I think is very interesting is just I sent a tweet earlier talking about whether or not, like, if you're in some groups of stocks, you could be doing very well. If you're in other groups of stocks and you haven't been I don't mean this in a mean way, but if you haven't been taking note of where there's strength in this market, and if you've been stuck in some of the older stocks of the last couple years, you may not exactly be happy. And it's to me, it's a testament of doing your homework and understanding, like from the very beginning of some of these months, both January and February, you got clues about where institutions want to be positioned in this market. And yeah, I would say the main theme that we've seen so far, of a couple themes, but it's been rotation. It's been rotation out of large cap growth, and I think this kind of pinpoints it. Right here, when you look at year to date, large cap growth is down 6.1%. Large cap value is up 7.9%. So, when you look at these charts, as I've been doing now, for this year, and understanding that these charts have really gotten skewed, over the years where you had growth outperform for a number of years, that's not normal. Like, growth can't just continue to outpace value forever, right? That just doesn't make sense. And what you've had is kind of like a big change. And that's happening in a lot of different areas. And, I also, I don't want to focus too much in this video because I want to go over some other things, but look at the difference between the IBD 50 ETF and the ARK Innovation ETF, right? One makes adjustments, one doesn't. One buys things as they're falling and breaking down, and they continue to buy it, and they're stubborn, and no matter what. And and that's down 9% for the year, versus a fund that does more of trend following, takes note of new trends, and tries to capitalize that. And there's a huge discrepancy in the performance there. As they're up 10%. So what that means to me is there are opportunities. We've seen other years where, you know, both ARC and the IBD 50 doesn't do well, but the fact that they're up 10%, it means that they've taken note of where there's strength in this market, and they've done a really good job at going in that direction. Um, and that's kind of what I've tried to do as well with the TTG Global Trend portfolio. That portfolio is up over 9% year to date as well. So all it is just taking objectively looking at what is strong and what isn't. Just a couple other things in here too. This has been a big year for dividends. Now, I want to talk more about this in just a second, but look at the select dividend ETF. Again, these are all things that this is not new. If you're new to watching my video, these are things that I've been talking about for since the beginning of this year, that these things have looked good. So that's up 12%, and investors want more of a. Is there more safety in dividends? Sure, you could argue that. It's definitely a bit more defensive, right? And then we'll look at some of the things that have done well. But before we do that, let me just start to review charts, and then I will go over the performance for the week. Charts. Where are my charts? All right, here they are. Let me just switch the screen around here. Do. So yes, SPY again. I feel like I'm doing a lot of this like almost every day, saying the same things. But yes, the market cap weighted S&P, which is dominated by your Mag 7 names, we know has been underperforming, and it's been doing that. That has been breaking down. That's nothing new. I see a lot of people now coming to that conclusion. But really, like, I tweeted this chart out probably about a month ago, and I said, this does not look very good. And it continues to go lower. Now, I don't want to get too negative. I've been negative this group, and I still am negative with this group, but eventually they will bounce a little bit, right? But that's what this looks like, right? And this is like there's an index with like a few different companies in here, but this is your problem area, and unfortunately, they're the largest stocks out there. So they dominate the market cap weighted indices. But like going through this and understanding that why the largest stocks are the weakest right now gives you a sense when you look at the RSP, which is the same names that are in the S&P 500 but equally weighted, gives you a sense that the average stock is doing just fine right now. And again, it's the average stock, right? That we're discussing here, right? And that has been doing quite well. And here's the dividend ETF, which was up again, was up 1% today and made a new all-time high uh, closing move. So now I mentioned in the beginning of this video that some things are starting to where some things are beginning to rest a little bit and come back in, which I think is perfectly normal. But you don't want to just see consumer staples, which were up again today, utilities, which made a big move, which I'm going to talk more in detail about this. But why do you think I asked this question? We do Q&A for members on Friday, and I asked this question: why do you think utilities went up this much? And a lot of people said, well, they're defensive, and yeah, that's basically it. But there's also the yields component. And that's what I wanted to kind of touch upon in this video too, is that something is changing in bonds. I don't know why this isn't getting as much attention as it should. I would think more people would be tweeting about it, but I get it. Sometimes I'm not trying to give myself on the pat on the back, but sometimes I'm pretty early with this stuff. But look at what's going on with bonds. And we'll start with the long end of the curve. Now, and let's look at the weekly chart for some of these, because now we have it's the end of the week. But that's a very big green bar there for TLT, and it's the first time it's over this 200 period moving average on the weekly chart. So it kind of looks like something may be beginning here, right? That so far this is the biggest move that we've seen this year in bonds, right? TLT was up 2.5%. Now, and I want you to remember something, right? We know that the administration wants a Fed president to cut interest rates. But remember, when I say cut interest rates, that's the overnight rate. That has nothing to do with TLT, which is the plus 20-year bond ETF. It has nothing to do with IEF, which is 7 to 10 years. But look at this, right? Look at what the 7 to 10 year bond is doing right now. Right? Another, really nice green bar, and that's new highs for the last going all the way back to 2022. That's the that's the highest of the 7 to 10 year bond, and this is dividend adjusted, so I'm including those. If you go even shorter on the curve, so IEI, right? This is 3 to 7 year bonds. Look at what this is doing. This is an all-time high for 3 to 7 year bonds. Again, you have to keep in mind that dividends uh, are added here. So it's going to look different if you don't adjust for dividends. But that's breaking above the 2021 highs. So there's some major strength going on here in bonds. Hence, we'll look at it this way too. Sorry, bear with me. I'll flip the screen around here. And I'll zoom in here so you can see that. But yes, look at where we are in terms of yields, right? So we're at 3.4. Now, keep in mind, hopefully you'll be able to see this. Where is the Fed at this point? The Fed's all the way up at 3.75. Right. So there's only a 10% chance right now that they're going to cut interest rates on March 18th. But I'll tell you something. If these continue to go lower, especially the 2 year, right, I think that's going to force the Fed's hand. Today we had an inflation report that came in. The regular CPI month over month was a little bit lighter than expected. So we've got something something different going on here. Now, I would also pay attention. I tweeted this chart out earlier. If you look at the 5 year chart of the 2 year yield, right, you could draw a line in here, which I did this earlier. But this may be beginning to break down. Again, we're at the very cusp of something happening here. Now, this could bounce next week and maybe go back up. But if this starts to break down, start heading down to 3%, 2.5%, right? You better bet that the Fed is going to be cutting interest rates if bond yields start to happen. There's a big relationship between the 2 year and what the Fed should be doing. So hopefully they'll take it. Again, I'm just saying that with a little bit of a grain of salt that they're going to be paying attention to this. But this is a very important relationship to watch. Now, here's the positive of this. Let's go back to this. I mentioned in the beginning of this video that there's not a lot of cash on the sidelines when you look at what funds are managing. But we know every once in a while we'll send out a tweet on social media or send a post on social media that there's a huge amount of money in money market funds. Why won't that money come out of money market funds? Well, it won't come out of money market funds because there's no need for them to take the money out of the money market funds because of this. You're getting a great yield by having money in cash, 3.75 for doing nothing. And by the way, that's now up. Now, I know the last couple of years that this would not be the case, but right now, if you're in cash, you are outperforming SPY and the Qs. So there's no need for any money to come out of all those big money market balances. But if this starts coming down, right? New money could be put into work if we start bringing this rate down to more of a normal interest rate of, like, let's say 2%. Right now we're still, again, this will shock some people when I say this, but right now this is a tightening rate. 3.75 is tightening against, it's putting the screws to the American consumer having interest rates this high. So you start moving it down to a more normal rate of, say, 2%. I'm not saying we need to go all the way down to zero, like like when there's a financial calamity or a shutdown where everybody has to stay at home. But so I'm not saying we need to go to two, but maybe we need to. I'm sorry that we don't need to go to zero. But if that 2-year yield falls, then we should be aligning the Fed funds rate with that. So that's the positive. Now, what that means is that you kind of have to be patient, right? I don't think this is going to happen like where we start drifting down here all the way down here like in a week, right? But maybe in a couple months. Again, this will be something to be watched. This 3.4 level will definitely be something to watch because, again, remember the 2-year, 7-year, 10-year, 20-year, 30-year bond yields are dictated by what? Not the Fed. They're dictated by supply and demand, by regular market forces. So these things go on their own, right? And that's always the horrible thing that you hear on social media when you hear, "Oh my God, the Fed's cutting interest rates. That's going to be great for mortgages." What? This has nothing to do with mortgages. Mortgages are tied to like the 10-year rate, right? Not the overnight rate of what the Fed governs. All those other rates are governed by supply and demand, right? So mortgage rates are governed by supply and demand. So this could be very interesting, but it might take a little while. Now let's look at one other relationship here too, but just to kind of see. But I think this is also very, very. Whoops, this is the wrong thing. But this is also like an important relationship. This is TLT with SPY. Now, to me, again, I'm just kind of leading in here. Whoops, I'm not looking at the right thing here. Sorry about that. So this is TLT over SPY. So again, it's just one green bar, like one data point isn't a trend. But I would definitely be watching this. We got to move into the value area for the year, and that should trigger the bullish 80% rule for this relationship, where bonds may be going to outperform for a bit. So some kind of things for some food for thought with this, and again, if being patient and understanding that this year might be difficult as it's kind of gotten for some stock investors who are only looking at growth stocks. Um, and just overall, it's been a bit bumpy with SPY exactly flat a month and a half into the year. So you might have more of things like this, bonds outperforming. But there will be, if that continues to happen, there's a light at the end of the tunnel, and possibly the Fed might be cutting interest rates, and there might be some new money being put to work in the market. But that's further down the line. For now, let's review some charts and let's go through the week's performance. Um, So as I'm switching around the whoops, share screen. So as I'm switching around the charts, I think patience is key here, for understanding why things are moving. Now, I went over the dividend chart and I went over the XLU chart. I wonder if that is being people go into utilities not just for defensive reasons. They go into utilities because of the yields. So if those yields, which I showed you, if those keep dropping, people might be front running that a little bit. And they're saying, hey, give me some yield in some of these areas like utilities, which were up 7.3% this week. Home builders also do well in that environment because you'll hear about this next week. It takes a few days for them to adjust the mortgage rates, but you'll hear next week there'll be a bunch of notes out from big social media people talking about, oh my God, mortgage rates have dropped to the lowest of this year. Right? Why aren't you hearing about that today? Because it takes probably about 3 or 4 days or so to before mortgage rates get published. um, there's a lag, right, between what the 10-year does and what mortgage rates. But you'll be hearing it. People will be retweeting 200 times about how great mortgage rates are the lowest they've been in months. But you'll get that tweet next week. I will probably tweet it out shortly. So, yes. So, but people are gravitating towards yields right now. It's almost as if they're front running something. So that's my thought, because people go into XLU uh, utilities because of that reason. All these other things. So let's go into some charts. But you can see financials did not have a good week. Metals and mining did not have a good week. Banks, not a good week. Transports with this, but that big thing yesterday, not a good week. Biotech concerns me. That's down 2%. So again, a lot of more. I don't want to say risk off because you got your home builders. It's just it's very rate driven and it's also a bit defensive driven. Semis were still up 1.5% for the week. And by the way, look at international. South Korea again, which led last year, is leading again this year. Japan also had a big week again. Taiwan, right? So there's still a lot of opportunity here in international. So let's go back to the charts for a minute and let's go through a couple things. How long am I running? Oh my God, I'm running. I don't know how I get through 20 minutes so quickly in these videos. So let's go through just a couple a couple charts quickly. Uh, I did not go through the cues, but the level to watch for the cues is, as I mentioned in yesterday's video, is 592.67. Again, this is just we don't know yet. I don't think that this is going to be the leader this year. And I don't think that this is in a good position, even though we made a little bit of a higher low here, just like with software. I don't, software's getting so much attention. There's this big thing too where people are talking about, oh, there's this correlation between Bitcoin and software. Do you know why that is? Right? The reason why that's correlated is, oh, sorry, I'm going to, all right. So here's the IGV ETF. Look at the movers today in the IGV. What do you notice with some of the stocks? Now I know I tweeted this out earlier, so you probably know this already. But Mara up 9.2%. What is Mara? Well, they're kind of tied to cryptos. What about this guy, MSTR? You ever hear of MSTR? That was up 8.9%. What about BMNR? That was up 6%. So the riot was up 7% today. Do you kind of get the picture? The reason why software and Bitcoin are correlated right now is because there's a lot of crypto related stocks in this ETF. Now, they're not, most of them are not the top weights, but they still have a pretty big impact when there's six or seven of these things that are all doing with what Bitcoin does, right? They're all some type of derivative of a derivative play of a crypto play. So that's that. And that kind of solves that reason why software stocks are correlated. The IGV is somewhat correlated with what Bitcoin is doing. It's not rocket science. Just look at the components of your ETF and you'll figure that out very quickly. Semiconductors. Now, this is again, I want to go over the good and the bad here. I don't know if this is going to be a double top. I would watch to see if this breaks the 20-day moving average and starts to head down. Now, this is still in a trend. It just may be due for some consolidation. Let's go through another area that is doing well right now. REITs. Why are REITs doing well? Well, because you know what kind of dividend that you get with REITs? Let's see. You get a dividend. It's actually not that much. It's 3.4%. By the way, the dividend yield in the dividend ETF is over 4%. So it's like I said, it's almost as if they're front running something going on in the interest rate market by going into higher yielding uh, yield replacements in the equity market, and that's what REITs basically are: real estate investment trusts. They offer big dividends. Um, where else did I want to go? I talked about, we could look at what energy stocks are doing, right? They're just kind of hanging out here, right? No big. They were up 0.7 of a percentage point. XLB materials, right? Still looks pretty good. Still overbought. So even though these things could come down a little bit, and they'll still be in a strong trend. Look at how far the 5-day moving average is above the 20. So I think this is a really interesting trend that's happening right now. We could look at the weekly too. The thing that people aren't realizing, and again, I'm sorry to be so critical of people, but some of these things have been going sideways for 2-3 years. Let them have some outperformance. It's okay, right? Especially when you look at these things, some of which have been going sideways for a long time. Look at Deere. I talked about this chart last year a lot, and I kind of gave up on it in here. But Deere is a great. I mean, look at over here. This was 2010, 2011. Oh, sorry, 2020, 2021. It's a good company. And a lot of these companies are getting into AI as well, right? So anyway, I've gone over this before. I don't want to make the video that much longer, guys. I want you to have a great weekend. But I think even if this market comes in, some things like this and like Caterpillar, right? Look at the weekly chart in Caterpillar. This is not a risk off stock. It's just a little bit different. Consolidating a little bit up here. So I think that there's going to be lots of opportunities. Um, they're just in some different groups, and so in any event, I'm going to leave it there, guys. Have a great weekend, and I'll see you guys on Tuesday.